if you're really looking to scale up, there's a few different boxes you need to check. You need to have someone has multifamily experience buying multifamily properties and signing on loans. Another box to check is you and your partners require to have combined net worth equal to 100% of the loan amount and then combined liquidity.
If you're a residential real estate agent earning $200,000 a year and you want to grow your passive income, this show's for you. Learn the secrets other agents use and hear from experts in our field in order to guide you along your journey to investing in assets like apartment communities so that you can turn your commissions into cash flow. I'm Randall McCleared. Let's go, baby. All right. Agents, welcome back to Agents Building Cash Flow. Excited to have you here today. We have a special guest. His name is John Brickson. He is the founder and principal of McKinney Realty Capital. He's a seasoned expert in the commercial lending field. And I'm excited to talk to him because there have been a lot of changes in the debt market in the last few years, financing multifamily properties and that sort of thing. So I thought bringing on an expert in the field would be the best to address some of those issues and give some advice going forward. So he's got over 10 years experience and he's done over 750 million in financing volume, over 80 plus deals. So obviously there's a wealth of knowledge there, a lot of experience seeing the back end of those transactions in order to understand what the equity looks like, what the debt markets look like, how deals are getting done, they're transacting, that sort of thing. So definitely pay attention, take a pen, paper, take some notes. We go through some very dense information in the very intro to the show. And so you'll see and understand how much knowledge he has just in a very, very quick intro to the show. So we unpack that a bit. We discuss the debt market. Like I said, he gives some advice on starting out if you're new to the multifamily space, kind of some of the things that you should be working on, building your team and that sort of thing. He drops knowledge bombs throughout the entire episode. So obviously, I don't want to spoil all of that. He does go over some red flags you should look out for if you're looking at offerings from other sponsors. And then we talk his personal investing journey because he's doing the same thing. He's an agent of the deals. He is trying to translate some of his active income on the lending side of the business into some passive deals. So he's invested as a limited partner. He recently bought a multifamily deal himself. He's been a key principal on some things. So again, he's got a wide range of experience and I know you're going to get a lot out of it. So let's bring him on the show. Let's get started. Let's go. All right, John, it's great to have you on. It's good to see you again. We've been catching up a little bit here and there and some of the stuff that we're working on. So I appreciate you taking the time to jump on, share your knowledge and talk with us about the debt markets and real estate financing. So thanks for jumping on.
Yeah, thank you, Randall. Good to be here.
All right. So as someone with extensive experience in commercial real estate financing and investing, I'm sure you've seen the industry evolve over the years. So I know, and all operators and anybody in real estate really knows that there's been a rapid rise in interest rates in recent markets, and that's created some headwinds and some challenges just for getting some deals done. So aside from that, in your opinion, what's been the most significant change in the debt market for multifamily operators, and how's it impacting their ability to secure financing for deals?
Yeah, I think the multifamily financing market and the commercial real estate financing market will change as we go through the cycle. And depending on where we are in the cycle, that seems to drive what types of products are most popular and what types of products most borrowers are financing with. And so, what we saw was from, just kind of looking at the last 10 years or so, from 2013 up through about 2018, 19, really up until about COVID, a lot of people were financing their acquisitions, at least on multifamily properties, with Fannie Mae and Freddie Mac loans. And that was really driven by where cap rates were relative to where interest rates were. And the reason I say that is because, Fannie Mae and Freddie Mac, they can go down to a minimum 1.25 times debt service coverage ratio. So they'll go up to 80% LTV. But the property's in-place cash flow has to be able to support the in-place debt service by at least 1.25 times. And what we saw was cap rates really came down quite a bit, especially coming out of COVID, with all the stimulus that came into the system. And so cap rates came down, interest rates increased slightly, at least up until 12 months ago when they really started to increase a lot more quick. And so what that really created was a situation where you could only cover at a 1.25 times debt service coverage at about 55 to 60% of the purchase price. So you really just couldn't get good leverage with Fannie Mae and Freddie Mac type loans. And so there was that. And then the other drawback with Fannie and Freddie is that their loans typically are what's called a yield maintenance or a defeasance prepayment penalty. And yield maintenance and defeasance, the cost of yield maintenance and defeasance is really driven largely by where interest rates are in the current marketplace. And so really what yield maintenance and defeasance are, or what yield maintenance is it is it's your prepayment penalty is equal to the net present value of all remaining interest payments on the loan. So if you were to do a 10-year Fannie Mae loan, and at year 5, you decide you want to sell the property or you want to refi the property, at year 5, you'd have 5 years of interest payments remain on that loan. So at the time of payoff, you as the borrower would need to pay the net present value of all remaining interest payments on that loan. And so a yield maintenance prepayment penalty is driven by, one, how much term is remaining on the loan, but then 2, what was your interest rate at the time you close a loan versus where are market interest rates today. And so what we saw was that interest rates really dropped from the time people closed on their loans to the time they wanted to prepay their loans. And so that really drove yield maintenance costs way higher. And so a lot of people who bought properties in 2017, for instance, they saw very great appreciation on their properties, a lot of rent growth, NOI growth. And after 3-4 years, they were ready to sell or refinance the property. And the problem was, because interest rates dropped, and they had a yield maintenance prepayment penalty, they had these extremely high prepayment penalties they had to basically just swallow when they went to sell or refi. And so what we saw was, number one, a lot of these loans became DSCR constrained at 55-60% LTV in the period after COVID. And then a lot of people were burned by these high yield maintenance prepayment penalties. So people really kind of swore off the fixed rate yield maintenance or defeasance type loans that Fannie and Freddie oftentimes will offer. And they started to move into the floating rate loans. And with floating rate loans, those are the interest rates on those obviously they're floating or they're adjustable rate. So your interest rate might be what's called term SOFR. So SOFR is the secured overnight funding rate. And that is really just a short-term index that is directly impacted by the Fed funds rate. So whenever the Fed hikes rates 25 basis points, SOFR is directly impacted. And so a floating rate loan or adjustable rate loan, your rate will be SOFR plus the spread. So that might be SOFR plus 200 or 250 or 300. And so for a long time, SOFR was at zero. It stayed at zero as, the Fed had this policy of zero interest rates into perpetuity, basically. And a lot of people felt like it was going to be at least into perpetuity. So really, everyone felt comfortable with a floating rate loan. I didn't foresee the Fed hiking from 0 to 5%, over a 12-month time frame. And so what happened was, the other benefit too with the floating rate loans is that they have the prepayment penalty is not defeasance or yield maintenance. It's typically just 1% of loan amount. And so a lot of borrowers felt like, hey, I can do this floating rate loan. Interest rates will stay close to zero, and I'll have a 1% prepay instead of having to deal with a defeasance or a yield maintenance. And I'm okay with taking the interest rate risk just because my outlook is that interest rates are going to stay close to zero for a long period of time, or at least throughout the hold of my loan. And so people started to transition into floating rate loans in 2020. And you could do floating rate loans with Fannie Mae and Freddie Mac. But the largest provider of floating rate loans really were bridge lenders. And a lot of these bridge lenders, they are private debt funds or private mortgage REITs or other types of non-bank type lenders. A lot of these bridge lenders became very active in the market in late 2020, 2021, first half of 2022. And one key difference with bridge loans versus Fannie Mae and Freddie Mac loans is Fannie Mae and Freddie Mac loans, whether it's a floating rate loan or it's a fixed rate loan, those loans are also debt service constrained at a 1.25 times debt service coverage ratio based on the in-place cash flow. Bridge loans are not debt service constrained. They can go up to 80% of purchase price plus 100% of CapEx. And what bridge lenders are really looking at are, what is the pro forma? What are the projected cash flows? If I make a loan today at 80% LTC, will the property's value increase? Will the property's cash flow increase so that in year 2 or year 3, once that bridge loan matures, can I get refinanced out of the existing bridge loan? And so people moved into bridge loans in 2020 to 2022. And then the Fed started to hike interest rates aggressively. And that impacted a number of different factors. But the largest thing that really impacted was the fact that people who had floating rate loans, now they're seeing their interest rates start to increase due to the Fed hiking. And so people today are shying away from doing bridge loans, the floating rate loans more so. A lot of borrowers are trying to finance their acquisitions with a Fannie Mae or a Freddie Mac fixed rate loan if they can get it. Those loans are still 55 to 65% LTV. Cap rates for multifamily properties or for other types of real estate properties will have to ultimately increase in order for them to be able to get to 70, 75, 80% LTV. So a lot of folks are doing fixed rate Fannie Mae and Freddie Mac acquisitions in the current market here in April 2023. But we still see some people who are doing bridge loans, and we're still seeing some situations where it makes sense to buy a property and finance the acquisition with a bridge loan.
You have so much knowledge. It's like that is a recap. So there's a lot of terms thrown around in there. If you are unfamiliar with some of those terms, then by all means, reach out. We can cover those in a little bit more detail. But in general, that is a short recap of what has happened in the last 6 years or so. It's awesome. So I have a couple of questions that stuck out to me specifically, and we'll kind of run through those. When is yield maintenance worth doing? Like, why was that even a thing? And is it in a rising interest? You're taking a bet that the rates are going to go up, and so your prepay is going to go down or it's going to be shrinking. That's kind of, so you're sitting there doing some betting, essentially?
That's right. I mean, it's really depends on what is your outlook for interest rates. And if you're doing a 10-year fixed rate loan with a yield maintenance prepayment penalty, the benefit to you as a borrower is you have some downside protection there because your interest rate is fixed. And so it's predictable. You know what your interest rate is going to be in year 3, in year 7, in year 10. But the negative is that you do really increase the value on the property. And if interest rates decline during your hold period, you can be in a situation where you have a much higher prepayment penalty. And in fact, because interest rates have been increasing recently, there are some borrowers that took fixed rate loans in 2021, 22, when interest rates were quite a bit lower. And that's actually helped them with selling their properties because they can sell their property. The buyer can assume that fixed rate loan. And a lot of times these loan assumptions that people are doing when they're assuming a Fannie Mae or a Freddie Mac loan, they're assuming a loan with a much lower interest rate than what's market. We've seen some properties that are listed for sale that there's a Fannie Mae loan with a 3.5% interest rate on it. Current Fannie Mae interest rates are 5.25, 5.5%. And so I bought a property for $10 million 3 years ago, and I financed that acquisition with a $7.5 million loan that has a 3.5% interest rate. If I'm selling it today, and let's say I'm selling it for $13 million, a lot of borrowers will find that loan very attractive to assume because they're getting, 60% or so LTV. They're taking a 3.5% interest rate. And that's actually helped a lot of sellers get their property sold in the current market. We're seeing a lot of borrowers do assumption. On the flip side, if I buy a property today for $10 million and I take a $7.5 million Fannie Mae or Freddie Mac loan, my interest rate of my loan is 5.5%. But then we get into a situation where interest rates drop down to 3.5%, and I want to sell the property in 3 years when interest rates are at 3.5%. Well, now I'm stuck with have this 5.5% rate loan where much higher than prevailing market rate loans. And most likely you're going to have to pay that large prepayment penalty. So it's a little bit of a double-edged sword with everything. Unfortunately, it's hard to have your cake and eat it too with, prepayment penalties versus fixed and floating rate loans. You can take a fixed rate loan, but you're stuck with the yield maintenance or defeasance prepay, or you can take a floating rate loan, but you have interest rate risk and you have a 1% prepay. I would say the in between on those two things is you can do what's called step down prepay, where it's not 1%, it's not yield maintenance, but it might be a 5% loan amount in year 1, 5% in year 2, 4% in year 3, 4% in year 4. And so you actually have a points-based declining prepay throughout the term. That's one way some borrowers will get around the prepayment penalties as well.
Yeah, we were talking about that. So getting, I guess, into the intro that you were going through, I wrote down a few more things. So I want to jump back into that. So you were talking about the market shifting into the higher leverage because of the bridge loans. And so what are some of the negative impacts to the market that you see from that, or were there any? Because in my mind, I think of it, and the higher the leverage, it makes it easier to increase the prices on the properties. And yet now we're kind of in this situation. So like, would you consider that to be a negative thing when we start seeing leverage go up or not?
Yeah, I mean, I think, I don't know if I would say it's negative necessarily. I think it's just kind of a natural part of the cycle. And later in like the credit cycle, we often see leverage increasing, underwriting standards start to decline. And so whereas lenders used to really focus on what is my in-place cash flow today, it morphed into where will my in-place cash flow be in 2 years or 3 years once my loan matures. And so that really allowed borrowers to push their LTVs higher, and which in turn pushed the purchase prices and the pricing higher. And so kind of saw at the end of the most recent cycle is that purchase prices really started to peak and pricing started to peak. But then LTV and leverage was also peaking at that same time. And so the drawback with bridge loans is they are riskier execution for the borrower and for the lender. They're shorter term loans. They're 2-year loans or 3-year loans with extension options. There might be 2 1-year extension options after a 3-year initial term. So they're shorter term. And then they also, a lot of times, for the most part, are floating rate loans. And so you're also dealing with that interest rate risk during the hold period. And there was so much appreciation from coming out of COVID up until first half of 2022. People really became so optimistic with multifamily and where valuations were going, where rent growth was going. There was kind of this mentality that you can't miss, just buy any multifamily property you get your hands on and borrow as much money as you can to buy it. That's, again, it's a double-edged sword. It's coming back the other direction now where seeing values decline, and you're seeing people right now who are simply just overborrowed, and the value of their property might be equal to or less than the current loan amount.
Have you seen a shift now? Are you seeing things come back, like the foreclosure or default rates taken up?
Yeah, I mean, we are starting to see some stress in the market. There was a 4-property portfolio in Houston that was foreclosed on last week. There was a $229 million in loans. That borrower, they did over $300 million in bridge loans with one lender in the Houston market in 2021 and 2022. Just crazy amount of activity and just high leverage. And not only did they have bridge loans up to 80% LTC, but they also layered in preferred equity behind that bridge loan. So they were really getting 90% of the LTV at closing. They also faced a lot of different headwinds where rent growth was flat. They were buying Class C older properties and lower income areas. So their delinquency, most likely increased. They had a number of evictions they had to deal with, and then expenses also increased. I mean, real estate taxes, at least in the Texas markets, have increased. Hopefully, we start to see some relief on real estate taxes as values come down. Insurance costs have really gone up. Payroll costs went up. Repairs and maintenance. So it was really just a perfect storm for them. And on top of all that, they paid top of the market prices with as much borrowed money as they could get. And so what ultimately ended up happening was they stopped making their loan payments, and the lender moved to foreclose on those properties. And so I think we'll see some of that, but it's not isolated to just today. It's not unprecedented. This is the real estate cycle. And we saw it play out in 2008, probably to a more severe extent or a more severe downturn in 2008 versus today. You saw it play out back in the early 90s with what was called the savings and loans crisis, which impacted a lot of different lenders in the Texas markets. And so it's history doesn't rhyme or doesn't repeat itself, but it often rhymes. And so I think you will see some more stress in the market. You will see some distress, but I think on the other side of it, the folks that are able to make it to the other side, I think we'll have some great opportunities to buy properties at much more attractive prices.
Yeah, for sure. Another thing that popped in my mind when you're going through talking about the lowering of the LTV that Fannie and Freddie, because they were at 70, 75, like typically?
Well, Fannie and Freddie, I mean, they can go up to 80% LTV. They would go to 80% LTV even in the current market. But what Fannie and Freddie do really well is they're very disciplined and very stringent on their underwriting criteria. They don't change their underwriting standards. They say, we want a 125 debt service coverage on the in-place cash flow, regardless of if you're at 60% LTV or if you're at 80% LTV. And we don't care where cap rates are going. If cap rates are higher, you're more likely to be able to get to 80% LTV. But if cap rates go lower, you're probably going to be constrained at 60% LTV. And I think from 2013 to 2017, it wasn't uncommon to see Fannie and Freddie going at 80% LTV on a purchase price on an acquisition. I think it'll be a while before we start to see Fannie and Freddie loans size to 80 LTV, because what will have to happen is cap rates will just have to increase. And I think that will take time to actually take effect.
So yeah, in my mind, like that's kind of a lagging indicator. Could be a leading, I don't know, but trying to figure out how the correlation between what they will lend, and it's the DSCR obviously. But if you see them pulling their loan to value down, then maybe the market's overheated because that's something that's built into their underwriting. Just thinking out loud, you know what I mean?
I think you're right.
Yeah. So because their underwrite seems to be conservative to be able to do that. That's great. Just worked it out in my own mind. So thanks for going through that. I do like their underwrite. I like the conservative approach to it. And then you're actually looking at the deal for what the deal is rather than what you hope it can be. And that's one of the things that is key. So if you can get an 80% LTV on a Fannie Freddie, then you know that the deal's pretty solid, or hopefully right. We're proud to be sponsored by Ridgeline Investment Group. Ridgeline has a track record of transacting more than $53 million in assets throughout Texas. Ridgeline is currently looking to acquire 100 to 200 unit Class B multifamily communities between 5 and 20 million in San Antonio, Temple, Waco, Tyler, and other Texas secondary markets. To learn more about Ridgeline Investment Group, visit www.ridgelineig.com.
Yeah, I would agree. I mean, it's at least a decent cap rate. But on the flip side of that, I would also say, if you're getting 80% LTV, that probably means that that's probably a leading indicator that cap rates are going to come down. Because if you're getting 80% LTV, you're probably getting a pretty strong going in cash on cash return. And other buyers will enter the market and will start to bid those prices up. And Fannie and Freddie will start to get DSCR constrained at 75%. Then they'll get DSCR constrained at 70%. And then all of a sudden, the bridge lenders flood back into the market. And we get to a point where you can only get 55 to 60% LTV with Fannie and Freddie. And that's exactly what we saw. But what was interesting is, for a while there, for probably a 5-year stretch, you're getting 80% LTV on acquisitions. It seems like kind of overnight, all these bridge loans just kind of flooded the market. And the market got just really shot up from end of 2020 through first half of 2022.
Almost like a subprime market almost, where it's just like, okay, yeah, we'll do it on the property. And it's not a one-to-one correlation, but in my mind, there is a correlation there too. It's easier and it's faster and it's higher leverage if you go that route.
I would agree. I mean, I think subprime is somewhat about right. I mean, I think the one difference, like the subprime boom in the 2008 crisis, was really driven by like consumer credit. And that was a lot of different residential home buyers being able to qualify for mortgages really with no documentation, no proof of income, and like that. The multifamily market, fortunately, is much, much smaller than the residential mortgage market. So that's one reason why I think 2008 is probably quite a bit more severe than what we're going to see in this current down cycle. The two parallels with it are a lot of times, a lot of these loans end up getting packaged into bonds and securitized. And if lenders are able to move these loans off their balance sheet quickly through securitization, they tend to be a little bit more lax their loan standards, just because they're not holding the loan at the end of the day. They're shifting that risk to whoever's buying that loan from them.
Yeah, for sure. What do you see, I guess, what are some trends or opportunities right now in the current debt market for multifamily?
Well, I think right now, for anyone that's interested in getting into multifamily and wants to start buying multifamily, I think it's a great time to get started. And it's a great time to educate yourself, network, start building your team. If you need a partner, find someone to buy multifamily properties with. If you're going to be buying your first multifamily property, or if you're really looking to scale up, There's a few different things, a few different boxes you need to check. You and or your partner need to have, ideally someone has multifamily experience buying multifamily properties and signing on loans for multifamily properties. That's one box to check. Another box to check is net worth and liquidity. A lot of times multifamily lenders like Fannie Mae and Freddie Mac, for example, will typically require you and your partners to have combined net worth equal to 100% of the loan amount, and then combined liquidity equal to 10% of the loan amount. So, if you're doing a $5 million loan, these lenders will want to see that you and your partner have combined net worth equal to 5 million, combined liquidity equal to 500,000. So I think it's a good time to be getting your ducks in a row, starting to network with potential investors, limited partners, and passive investors that can invest with you on properties that you want to buy, and position yourself to be able to buy multifamily properties. If you're an active multifamily investor, you have loans that are outstanding right now. Say you have bridge loans right now. I would be taking a look at, let's look at my T12. Where's my in-place cash flow? Can I qualify for a Fannie Mae or Freddie Mac loan today that can take out my existing bridge loan? If not, where does my cash flow need to be in order for me to be able to take out Fannie Mae and Freddie, or my existing bridge loan with the Fannie or Freddie loan? And, can I actually get to that level? If not, what's my plan to get out of this? Do I need to do a capital call? Can I sell the property and get out of the existing loan? Kind of build a fortress around your own personal balance sheet and get to a point where, hopefully in 2024, when a lot of these loans are maturing, you're in a position where you can go on the offensive and you can take advantage of some of these different deals that we'll see in the market, instead of being on defense and having to put out fires.
Yeah, for sure. And speaking to that, building the team out and all that, what are some strategies for building relationships with guys like yourself? Go to coffee, or like building your team out, talking to lenders and that sort of thing, like just growing your network in that sense in order to secure favorable financing? Is it courting every lender you talk to? Going deep on one? Like, what do you think?
Yeah, no, for sure. I think finding a good, experienced financing professional, whether it's a commercial mortgage broker like myself or direct lender, and then talking to them about, here's my current team. If I'm going to buy a property, this is my partner. Here's our personal financial statement, sharing that with them and allowing them to review that to see what kind of loan you and your partner can qualify currently, doing those types of things. And then, as a lot of us already know, listing brokers, at least in the Texas markets, and for multifamily, really control the market, and they have all the different deals. So you want to get in front of listing brokers, make sure that you're seeing the properties that they're selling, the properties they're listing for sale, and then different properties come on the market, go ahead and underwrite those and see if they're a good fit. And what I would say is, if you are interested in buying a property, for me at least, it's never too early to reach out. We're happy to take a look at whatever you're buying and provide some feedback on what types of loan terms are available for that property. Ultimately, you can use our loan terms to underwrite the acquisition. So what I would say is, never too early to reach out for getting a good read on what the financing will be, and can be before you even submit an offer. I would just say, staying in front of your loan broker, staying in front of listing brokers to make sure that you're seeing their deals, and then just continuing to underwrite acquisitions once you have your team in place.
Yeah, for sure. Got a question. Obviously, you see a number of deals. You have a unique position in the debt structure, and I guess in the multifamily structure, because you get to see a lot of deals that come through, and you're early in that conversation, and then you're involved throughout the close. So you get to see the equity raise and challenges people may be facing in that arena as well. So to that point, right now in this environment, have you seen operators having a challenge, or is it pretty easy to raise? Is it deal specific, operator specific, or what are you seeing on that side of it?
I think right now the equity raising environment is more challenging for sure. I think even for more experienced sponsors, it's a challenging market to raise equity. What I would say is, if you are going to buy a property currently, ideally it's an equity raise that you're very comfortable with and that you feel confident you can execute on. Maybe the last property you bought was a $10 million purchase price and the total equity raise was $3 million. Maybe for the next property you buy in the current cycle, maybe you target a $6 million property with a $2 million equity raise, just to kind of test the waters and see if you're able to close on it. So I'd say the equity raise environment is a little bit more challenging, but on the flip side, there's not as much competition on acquisitions. There's not as many people who are bidding on properties that are currently in the market. And a lot of times the purchase and sale agreement, 2021, a lot of borrowers were having to, on most of these purchase and sale agreements, people were having to put up 2% of the purchase price as non-refundable earnest money day one. So if you're buying a $10 million property, you and your partners were having to put up $200,000 in non-refundable deposits just to get the property under contract. And what we're seeing is that the sales environment has become less competitive. And so you might be able to buy a property and maybe your earnest money isn't non-refundable until, week 2 or the 4th week of the contract. So it really just depends. But I would say it is a more challenging environment for equity racing right now.
I was talking to a few retail guys and commercial real estate guys, and one of them was in Detroit, but he's telling me about some of the deals that he's looking at and how he's kind of kicking himself. He didn't buy something early in his career because he was underwriting himself out of the deal. And so I've heard guys talk about that. And so it seems like multifamily, if you weren't underwriting in the recent years, if you weren't underwriting for year 2 cash flow and year 2 pro forma numbers, then you weren't winning a deal. So like right now, are you seeing a return to like in-place cash flow underwriting that is working because it's obviously more conservative than the year 2? Are you seeing that? Or is it still like, even some brokers I talk to, they're like, yeah, you need to underwrite pro forma numbers, not on in place. And so, yeah, I'm just kind of curious.
Yeah, no, I would agree with that. I think a lot more people now are focused on the in-place cash flow and really underwriting based on what is the in-place cash flow. Going in cap rates have become a lot more important. And there's people who are filtering out anything that has a going in cap rate less than 5.5%. They won't even look at. I would agree with a lot of these brokers that I think that is a mistake. I think people should also be looking at pro forma and thinking about how much upside is there in the cash flow here. And I think a lot of the best deals coming out of this downturn are going to be properties that have very low in-place cash flow. The best opportunities might be properties that are 70% occupied and the NOI is fairly positive. And that doesn't necessarily mean it's a bad deal. It could just mean that, the in-place cash flow is very depressed, but then by the time you execute on the business plan and get the property stabilized, your stabilized cap rate might be well above where market cap rates are. You might have stabilized cash flow at 8%, an 8% cap rate, where market cap rates are at 6%. And like, that's a pretty good spread because then you can go and sell that property at a 6% cap rate. And that difference between the 8% and the 2%, that's your profit as the investor. So I would say I would consider everything out there that's in the market, whether the in-place cash flow is really depressed or the in-place cash flow is strong and you're able to buy at a higher cap rate. So it's a little bit of a balancing act.
Yeah. All right. That's good advice. So I want to bring it back to the lending side. So the whole show is agents building cash flow, trying to get more agents to invest passively, get them into syndications, get them into funds, get them to like start building their cash flow, turning the active income into passive income. If I'm an agent and I'm looking at like a syndication as an LP, what are some red flags that they should look out for in sponsor offerings from your perspective, either the debt side or just from your experience?
Yeah. And I can relate to that because I'm also an agent and I'm paid on commissions. And my whole goal is to turn my commissions into cash flow. And so I personally invest in multifamily. I invest in industrial as well. So I own properties, multifamily properties on my own. One I own with no partners. Another one I'm a key principal on. And I have a couple of other partners and we have passive investors on that as well. And so I'm totally familiar with that as well. And what I really look for if I'm investing passively, I think one thing that people really disregarded, I think in 2021 and 2022, early part of 2022, that I think is going to end up coming back to haunt some of these passive investors is what is the capital stack look like? What does the financing structure look like? Is someone buying a property and are they taking 75 or 80% bridge loan with preferred equity behind that bridge loan going up to 85% or up to 90%? How much are they talking? If someone's doing a syndication, if there's a syndicator doing a webinar, are they spending any time at all talking about here's our financing structure, here's our financing strategy, here's why we think it makes sense, and this is why we're comfortable with it? So understanding the risks of the capital structure, they're buying a really large property and they're doing a 75 to 80% bridge loan. There could be situations where that is the right execution. But there could also be situations where that's not the right execution. If it's a really large property and they're doing an 80% LTC bridge loan, well, that sponsor, that key principal, they better have really strong personal liquidity so that if there are issues in the property that come up. Let's say they need $500,000 to carry them through, a soft period in the market, or if CapEx comes in higher than expected. Well, ideally, they have personal cash on hand to be able to carry that project. So that's something that's important. Another thing that's important is who's on their team. Are they working with experienced key principals that, have done this before? Do they have, the right attorneys and, financing brokers on their team that have experience? So that's also important. And then just also the underwriting itself. So looking at reviewing their pro forma, reviewing what types of rents are they projecting? Are these rents that they're projecting, are these already being achieved in the market, or are there really no good rent comps on this property? And then the last thing that on the underwriting is just like the exit cap rate. I think current market cap rates are, around 5.5%, depending on the property type and the market. Let's just say it's 5.5%. So if an exit current cap rates are 5.5%, then when they're selling the property in year 3 in their projection, they probably shouldn't be using a 4.5% cap rate when looking at their sale. And I've seen that as well. I mean, I saw a recent syndication where the borrower was doing a fixed rate loan with 60% LTV. So like those both sound good because it's lower leverage and they're 60% LTV. But on the flip side, my negative look at it was they have a loan with a defeasance prepayment penalty, which is similar to a yield maintenance prepay. But let's just say it's, for the sake of use, let's just say it's a yield maintenance prepayment penalty. But on their exit in year 5, they're not showing any prepayment costs. So they're basically assuming that the borrower is going to assume their Fannie Mae or Freddie Mac loan that has a 5.5% interest rate. And then the sales price they were projecting in year 5 was a 4.5% cap rate. And so on the front end, the loan looks very conservative and it looks like they're getting like a low LTV Fannie Mae or Freddie Mac loan. But on the flip side is when they're going to sell it, their exit assumptions to me weren't market and didn't make any sense. So there's a lot of different levers that can be pushed and pulled in underwriting assumptions, and it's hard to know. But what I would say is if you're looking to invest passively, invest with people that invest with people that you have a relationship with. And that's what it ultimately comes down to is, do I believe in the sponsor and do I believe in, their ability to execute and get it done?
That was gold. Honestly, looking at the exit cap rate and understanding that and putting it together with the defeasance and yield maintenance and making sure that picture is absolutely clear. I actually looked at one recently that was very similar to that, and it just didn't make sense. It was probably the similar spread. It's 5.5 going in, 4.5 going out, and it was like a huge shift in sale price and the price per unit that just didn't, over 3 or 4 years, didn't really make sense.
Yeah. Something else I would say too, Randall, and like it's not the same standard for all deals, but a lot of times there's very little cash flow. At the total projected return is 80%. And they're showing 5% cash on cash in year 1, 5.5 in year 2, 6% in year 3. Like there's hardly any cash on cash. And then all of a sudden, in year 5, there's like this big pop in appreciation because they're selling the property. That's also a little bit of that's worth looking into. It's why is all of the return back-ended here? Why isn't there more return during the hold period? And there could be a good reason for that. It could be because they're buying a distressed property and the property's 50, 60% occupied and they're having to take a bridge loan at a higher rate. So there's really no cash flow in year 1 or year 2. But it could also be that they're buying a property at a really tight cap rate, very low going in cash on cash. And then they're projecting that in year 5, they're going to sell it for an even tighter cap rate. Something like that's a little bit more problematic.
That's a very quick indicator that you can look at if you're reviewing somebody's OM on a deal or offering on a deal. I mean, that's typically you're seeing that cash on cash number in any kind of memorandum or offering that a sponsor is putting forth. And so if you see that, you can key into it very quickly and say, there should be a story here. It is exactly that. Okay, we're doing a bridge and we're going to reposition the property and doing all these things. But as an investor, you should know that going in because that's a very different strategy than an investor or like a limited partner looking for cash flow on an ongoing basis, because that's not that deal. That's more like a development deal where there's no cash flow, big pop at the end, go on your way once you get your money. Again, know that. Very good advice there. So got a couple minutes left here. So again, on the personal investing side, what are some of your strategies and what are you looking for in deals that you're buying right now?
Yeah, I mean, a lot of times I've mostly invested passively, and a lot of times I'm investing passively with my clients just because I know them really well. And then I know the properties really well. I've underwritten it myself and understand the business plan and understand the market they're buying in. So those are just the properties I'm most familiar with and the sponsors I'm most familiar with. So a lot of times I would invest passively in those types of deals. In 2022, I bought a smaller property just on my own with no partners, just because I wanted to have that experience of owning a property with no partners. So I bought a 9-unit property here in Dallas, a really good location in Dallas, in Old East Dallas. The property had been fully rehabbed and upgraded, almost no deferred maintenance. It was really kind of a turnkey type of deal. And it was actually a pretty good going in cap rate in a dense infill location with lots of population growth, a lot of jobs, a lot of income growth. So I felt like that was one where I could buy it on my own with no partners. I didn't think it's not going to be a home run. I think it'll be a single or double. It's a get rich slow type of deal. And for me personally, it made sense because 2022, I didn't see a whole lot of passive opportunities that I was interested in. And being an agent and being a real estate professional myself, I also want to get depreciation and be able to offset some of my commission income with depreciation. And so I was looking for something to invest as a tax shelter. And so my thought process was, okay, we're getting into the second half of the year. I haven't had a lot of passive investing opportunities to invest in. This property in East Dallas looks interesting to me. And so I ended up buying that and being able to enjoy the depreciation and the tax benefit.
So you've got it. Are you doing day to day on a 9-unit, or have you outsourced that to property management? Are you going and changing toilets? You got your plumber wrenched yet or what?
Definitely not. I can hardly change a light bulb. So I don't think you want me doing anything on any of these units. We have a third party property manager. And that's part of the reason I chose the market that I chose, is that if you're buying a 9-unit property or less than 20-unit property in a lot of different locations, it's very hard to find decent third-party management. But this property is really in the city of Dallas. It's about 10 minutes away from where I live, so I can go by there at any point in time and check in on it. And there's also a lot more third-party property management companies, these size properties here in the city. So my thought process was it'd be a lot easier to find someone to manage, a property that size if it's infill location in Dallas versus if it's out in Garland or Mesquite or Waxahachie or wherever. So we have third-party management, and I've been pretty pleased with them so far. And so far it's been solid. We've been able to get some growth on rent and then also on other income, and expenses have been steady and we're cash flow positive. So I've been happy with it.
Yeah, great. So is that something that, like a product type that you want to duplicate and just rinse and repeat and kind of add to the portfolio? Or is it just, you think it's one-off and you'll start going passive again once the opportunities present?
Yeah, we'll see. I mean, I think I might end up holding on to it forever, or I can see myself selling it after a few years and 1031ing into a larger property. I think the next property that I want to buy something that's a little bit more of a heavy lift and more of a value add, and something that really has some more opportunity for appreciation. So I think that's what I'll be looking into. And I haven't really been as active on doing syndication and raising money and buying properties, but it's another avenue I may explore, here over the next year or two, just depending on how busy I am with my day job and, running McKinney Realty Capital and helping my clients with financing properties they're buying.
Yeah. Awesome. So yeah, a lot of experience, man. You've got a range of experience from the LP side, the debt side, and now actually the principal side. You're going in on them. So very cool. Lots of information. Thanks for sharing all of your insights. Let's get to know John a little bit. What's your favorite pastime not related to real estate?
My favorite pastime not related to real estate. I'm kind of a jack of all trades, master of none when it comes to hobbies. There's a lot of different things I like to do. I like fishing, I like skiing, play a little bit of golf, play a little bit of tennis. I've started to get a little bit into hunting more recently. So I've been some duck hunting earlier this year. Love sports and following sports. I went to the Rangers game here in Dallas last night. I was lucky enough to go to the Masters this last weekend. So I was out at Augusta National on Sunday. So that was really cool. So yeah, I like to read. I can show you my bookcases here at my place, and I got a lot of books on the shelf. So love to read. A lot of different interests for me. Stay pretty busy outside of just real estate.
Very cool. So Masters, how was that? You enjoy it? My brother's out there recently. He went, and after he came back, he's like, okay, I'm looking for a house out there. He said it's beautiful, and there's some new developments that are coming up around there. They actually flew out and looked again. Yeah. So you buy a place out there, man. We'll go out.
Augusta's really cool. I mean, Augusta National, the grounds are immaculate. Just so much history and tradition right there. You know, seeing all the golfers in person and seeing some really cool shots live was awesome. Would have loved to see it be a little bit closer between Rahm and Koepka. They're going to the final round, but you know, we were lucky because we got there on Sunday, and the weather on Saturday was pretty bad, but Sunday afternoon weather was perfect. So
did you make it out on Saturday?
We got in on, I stayed in Atlanta on Saturday night, and we were planning on going to the Masters on Sunday all along. We had a ticket for Sunday, so we were going on Sunday. But yeah, I got it on Saturday, stayed in Atlanta Saturday night, and then we drove to Augusta on Sunday morning.
Yeah, nice. Did you get any rounds in when you're out there? Did you play?
I didn't. No.
Well, then I want to ask this, but I don't know. Maybe you just answered it. What's the best thing that's happened in the last 60 days?
Probably getting invited to go to the Masters might be the best thing that happened in the last 60 days. Yeah.
Pretty awesome. And then finally, name one or two people who've been most influential to your success.
I think that's an easy question. Probably my parents. And they were role models for me. And they were hardworking people and humble and treated people well. So I think they're probably my best role models.
All right, John. Thanks for being part of Agents Building Cash Flow. And for all you listeners, whether you're starting out as a seasoned or you're a seasoned investor, just know that syndications and real estate funds offer great opportunities for passive income growth. So keep listening, keep learning, and keep building your wealth. We'll see you on the next episode.
All right. Thanks.
Surprisingly, most of the agents we speak with got into real estate hoping to gain passive income and become work optional. However, only 1 in 5 ever start investing. Most are simply too afraid to start. Once you get educated by listening to this show, you'll be able to overcome that fear and become the 1 in 5 who are finding financial freedom. Don't miss a single episode. If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. And we'll catch you on the next episode.